Okay, I think we'll get started. Welcome, everyone. My name is George Constantine. I am co-chair of the Nonprofit Organizations Practice Group here at Venable, and want to welcome you all to today's webinar on a topic that is, I think, increasingly important to a lot of the nonprofits that are participating today and a lot of the groups that we work with on a day-to-day basis. It's titled 10 Years In, OMB Makes Significant Changes to the Uniform Guidance, Learn from the Experts. And so this has to do with a lot of our grant recipients, award recipients, and folks who have to have sort of, along with the benefit of receiving grants and support from the federal government, there's a lot of compliance and obligations that go along with that. And we're pleased to have a great panel here to discuss developments going forward, led by my colleague, partner Diz Locaria, who is a partner in the government contracts practice group here at the firm, and who I've had the pleasure of working with on a number of different matters together with some of our nonprofit organization clients. Diz works on government contracts and, importantly, government grants and awards for compliance issues and other types of advice that may come up when our nonprofit organization clients have had the receipt of grants and awards. And have the pleasure of working for a number of years with Diz. And Diz will introduce our guest panelists as well, Marc and Dan, after I turn it over. Just stay tuned, everyone, for those who are regular participants of our webinars. We will have invites coming out soon for upcoming ones, and always appreciate any feedback that you can give at the end on ideas for other ones and how we can improve. So please be sure to provide that feedback when prompted. I will quickly turn this over to Diz. I'll disappear and become a participant just like everyone else and enjoy the program. So Diz, over to you. Thanks.
Thanks, George. And thanks, everybody, for dialing in today. Appreciate everyone's time and attention. As George mentioned, there's some significant changes to the OMB uniform guidance, and we look forward to sharing that with you all today. As George mentioned, I'm joined, I work at the Venable law firm and I'm a partner in the government contracts group, but I'm joined today by two friends and colleagues that have teamed up together to recently found an organization called Award Advisors. And I've worked with both Marc and Dan for a number of years on various grant related issues. And so when George asked me to put together a presentation for today, I immediately thought of Marc and Dan. And so I'm happy to have them here with us today. They are CPAs and accountants and really know the inside and out of the accounting side of things. I advise a lot on the legal issues, but rely upon folks like Marc and Dan frequently to help with various cost issues and accounting issues. And both these gentlemen are first rate. So happy to have them today. Let me turn it over to Marc and Dan to say a little bit about themselves and Award Advisors, and then we'll kick things off.
Yeah, thanks, Diz. Really appreciate that. So Dan Durst here of Award Advisors, co-founder with Marc, and we're based in DC. Both Marc and I, we've got careers in this space. I actually started as an auditor in the DC metro area, auditing State Department grantees and contractors, and also doing single audits for some local nonprofits. Made the transition to consulting shortly after uniform guidance was issued, as I saw a big need for training and education as it related to compliance and the accounting requirements that come with uniform guidance and those grants. And so been doing that now for over a decade, and it's been a lot of fun, made a lot of great contacts, and hopefully provide a lot of value to folks. I still live in the area, graduate of George Mason University, got my bachelor's and MBA there, and I'm a water person, so typically I'm either at the Eastern Shore or in the pool or something like that, especially in this heat wave. So, Marc, go ahead.
Hey everyone, Marc Bucalo, certified public accountant. I've been in the federal grant contract space my entire career, which is about a little over 20 years. Like Dan, I started as an auditor, and then I became the auditee. And I'm not sure which one's easier or what side I like better. Dan uses the term of we like to be in the business of clean audits these days. And so that's what, Dan and I have teamed up to do, is to really, advise clients, on compliance, financial management, audit, indirect cost rates, accounting. Diz did a fantastic job of introducing us, and so I'll kind of stop there. But yeah, looking forward to presenting to you all the changes that OMB has issued, and so yeah, let's get into it.
Great, thanks, Marc. So we'll talk a little bit about how we got where we are, and then the effective date of these changes, and then the three of us will go through a number of these revisions. We'll talk about the good, the bad, the ugly, and then we look to, if we have any time at the end, we'll look to answer any questions that you folks have. We'll try to get as many in as possible. We have a lot to cover, so I'll turn it over to Dan to kind of get us started on how we got where we are.
Yeah, so if you've been in grants as long as a lot of us have, you probably remember the days of the old OMB circulars, OMB A122, A133, and so on. Well, in December 26 of 2013, OMB issued its final guidance, this uniform guidance that we know as it is today. And this was like a way to consolidate all of those OMB circulars, bring it into one place, distribute all those requirements into easily navigatable, subparts as you know them today. Whether or not it's easy or not, but it's all in at least that one body of regulation. And so for essentially the Uniform Guidance 1.0, kind of the first version, it became effective for awards that were issued on or after December 26, 2014. I remember I was auditing at this time, and we were, as auditors, bombarded with CPE on the release of uniform guidance and all the additional requirements. And really, I don't think that the grantee population was provided enough education opportunities by the federal government to really, kind of bring you up to speed on these new requirements, the procurement standards, and all these very complicated things that they implemented. So then, over the course of a year, there was a mandate in there that, ultimately uniform guidance will be updated about every 5 years, and they tried to stick to that. So on August 13th of 2020, OMB issued its first set of kind of multi-part uniform guidance revisions. There were two provisions that were immediately, applicable on that date, and that was the prohibition of certain telecommunications and video surveillance equipment purchases, the Chinese national produced, telecom equipment and so on for national security reasons. And then the second piece was the enhanced termination provisions that was really in the favor of the federal government. The rest of the revisions became effective on November 12th of 2020. And really, this was kind of our Uniform Guidance 2.0. This was our second revision that was put into effect in audit and in all of your agreements and everything else. And so fast forward, about 5 years later, 4 or 5 years later, on April 22nd, OMB issued the latest and most comprehensive revision uniform guidance yet, which is the date, and that we'll see implemented soon. And that's our Uniform Guidance 3.0. You can go next slide. And so the Uniform Guidance 3.0, the latest and greatest, right? When is it effective? Well, it's not an easy answer. It's not straightforward because, as we know, agencies like to do things differently. Every agency kind of marches to the beat of its own drum, so to speak. And so OMB has the official effective date of the final rule as October 1st, 2024. However, there are these kind of caveats built in. Federal agencies may elect to apply the final guidance to federal awards issued prior to October 1st, 2024, but they're not required to do so. So you can have early adopters. For agencies applying the final guidance before October 1, 2024, the effective date must be no earlier than June 21st, 2024. So we're about potentially 6 days into what could have been an early adoption by an awarding agency. I'm not aware of any that have publicly stated that they have done this early adoption. So I would, kind of stay tuned to your awarding agencies, keep an eye on your agreements as well. Look for modifications to come through that incorporate the new guidance, and then look for the FOAs and NOFOs that you're applying for to see whether or not they're incorporating some of these changes, as they probably expect to issue those awards after October, depending on the life cycle of that pre-award phase. I think the general consensus is it'll probably be similar to the way that it was rolled out in the past, and that many of the requirements, the new revisions, will be applied based on the awards issued on or after approach. So basically, we could expect these new uniform guidance provisions to be in effect for awards issued on or after October 1st, 2024, like at the latest. Unless you get a mod, right, that says, hey, it's active to these historical or legacy awards as well. So that's it.
One
Dan, did you
interesting.
Go ahead.
Oh, go ahead, Marc.
I was going to ask if you touched upon the audit. A lot of people have questions about when those audits will be applicable. Yeah.
Yeah, the increased audit threshold.
Yeah.
Yeah. So typically, the way that this would work in that sense, the way it was done when they raised the single audit threshold from 500,000 to 750, I remember those days, and that was for fiscal years beginning on or after. So if we look at October 1, 2024, fiscal years beginning on or after October 1, 2024, I would anticipate the single audit threshold to be revised and get applied to. So if you had a fiscal year that began in June, July 1, a lot of folks have a June 30 year end. If you had a July 1, 2024 fiscal year start, I imagine that fiscal year is still going to be subject to 750. It's the July 1, 2025 fiscal year start. That fiscal year, you'll see the $1 million threshold apply, which we'll talk about in a second.
One thing I wanted you kind of suggested this, Dan, in your comment, which is, the agencies kind of march to the beat of their own drum. And one of the things about the uniform guidance was it was meant to be uniform, right? But as we've seen over the past 10 years, the agencies have all kind of modified it in their own ways. Even the implementation date, they have a right to modify it in their own way. And so one thing, I think this rewrite helps to bring some stuff back in line in a uniform fashion. But one thing to always keep in mind is that agencies may have more specific or deviations from the uniform guidance that folks just should be mindful of at all times. So as uniform as we like things, the agencies tend to do their own thing, as Dan said. Okay. Well, I'll turn it over to Marc to talk a little bit about the overview of the revisions and go from there.
Yeah. So I don't know if you all had noticed on Dan's timeline, seemed like every 5 years, the OMB was doing something. Well, interestingly enough, if you look at the regulations, the old ones in section 109 actually required OMB to review and revise the regulations every 5 years, right? It was explicit in the regs. And so one of the changes that you'll notice is that they've reworded that, I think, in their favor, where they've removed we will review every 5 years to we will review periodically, right? And so, it'll be interesting to see, how frequent and, when our next update will be. But anyways, we're all here today, and we want to hear what the revisions are today. And so, OMB's goal with all of this was really to improve, stewardship over federal funds. We wanted to promote equitable access to programs, reduce administrative burden, and streamline and effective oversight for federal agencies. And there's kind of three major kind of overarching elements here, which that the revisions really are trying to get after. And that's it eliminates several actually prior approval requirements, and we'll get into kind of what some of those are. I think Dan will actually touch upon some of the old regulations required certain things to be approved in advance prior to doing them. And so some of that burden has been lifted, and Dan will get into that in a minute. The other thing is with thresholds, right? In an effort to reduce that burden, they've increased certain thresholds, and around equipment, supplies and so forth. And the audit threshold was one. And so again, we'll get into details on that in a little bit. And the third thing is really that they wanted to create clarity for the agencies and the recipients. So a lot of the language has been updated to really help both agencies administer the awards, but recipients to be able to navigate, right, and find better access and streamline processes for the recipients to get these awards. Let's see. Can we go to the next slide?
Yep.
Yeah.
Talk about the good news.
Yeah, the good news. And there is a lot of spin. I mean, when OMB announced this, it was a very positive thing, to get everyone amped up about all these good changes and it did. There's a lot of good stuff in here that is trying to achieve these objectives that they set out to, and yeah, we'll go through that and highlight some of these things, but we will also go into the bad news, right? And what we mean by that is there are things in here that weren't advertised, right, as being great, right? And so Diz, Dan, and myself, we live in this world. We've dissected this thing, and so we hopefully at the end of this presentation, you'll see some of these things that we're going to highlight as bad news for you to really focus in on, pay attention to, right? Because no one has really kind of waved the flag yet, and so we'll hopefully do that for you. I guess you could go to the next slide, Diz.
I think we talk a little bit about each of them here, and then we can go into the backup slides.
Yeah, this is just sort of a I guess so. The two CFR 200 is broken down into subparts, right? And I think what we've done here is just sort of highlight some of the good things, right, within these sections. And this, each one of these sections, we have a slide that kind of details behind what we're going to talk about. So yeah, all right. So you've already moved to the next slide, so we can go into equipment. Yeah. So what do we want to mention here is this is one of those threshold increases, right? Where they originally had equipment set at 5,000, right? And so that's, tangible personal property that has a useful life of more than 1 year, and a unit acquisition cost of equal or the lesser of your capitalization policy, right? And so that's a tricky thing that sometimes people get tripped up on, is that for GAAP basis reporting, you might have a lower threshold than $5,000, and so you're then held to these equipment standards, right? And so lots of times we advise companies to try to align their capitalization policy with these thresholds, and so that may mean your organization may consider bumping up to $10,000. That's a decision that you have to discuss. But from a compliance perspective, actually, I'll get into that in a later slide, because there's another section in the regulations that actually talk about kind of the things that you have to do when you have equipment, right? There's inventories and there's requirements around safeguarding that equipment. But one more thing to point out on this slide, and this is kind of throughout the regulations. What they've done, actually, let me take a step back, and I'll give you kind of my opinion on the changes here. Some of the prior changes, when we first had uniform guidance, that was a complete rewrite. There was a lot of significant changes, taking all those circulars, merging them, changing the language. There were significant changes. This, I guess, in my opinion, is more of a red line. It's more about language. Like if you get into the nuts and bolts of all this, in fact, there's a great resource on, I think it's cfo.gov, where they actually show you the changes, and it's just a red line document, right? It's like a Word document. that you would, you could see all the changes crossed out and edited. And so a lot of it is like language based. So it's not a real full rewrite of the regulation. So I just wanted to make sure I got that out there. And one of those changes, I guess, is what I wanted to highlight on this slide, is that they changed the word non-federal entity. That they're no longer using that. They're using instead recipient and subrecipient, right? And so I'm not exactly sure why they did that. Maybe because there's for-profit entities that maybe are subject to this and whatnot. But anything else to add here, guys, or you want me to move to the next slide?
Yeah, I think we can talk about supplies and then how that impacts modified total direct cost.
Yeah, they change. So they change supplies to supply. And again, here, same thing with equipment. They're increasing the threshold from 5,000 to 10,000.
Yeah, in many ways, I feel like those two thresholds are attached when you think about property management and accountability, and there is no in between there. So if they were to increase the equipment threshold to 10,000 but leave the supply threshold at 5,000, there would have been a gap there of like, well, what do we do with this stuff? So this way, as I'm sure you're aware, the management requirements for supply is much less than for equipment. And so this should reduce administrative burden now that your supply will be up to $10,000, per unit, which, that's a pretty expensive supply. So,
but Marc does point out a very important piece, which is it could be as high as 10,000, but that depends on your capitalization policy.
Yep.
And to the extent you can make those align, all the better, because it will relieve some of that administrative burden by categorizing certain items as supply as opposed to equipment. But it is the lesser of those two. So making sure that you look at that policy and make sure it aligns is an important point. Okay.
You want to move on to
Marc, and so how does that impact I guess, and then the changes to the MTDC?
Yeah,
another important
this area and the de minimis rate are two areas that people seem to have a lot of interest in, right? Because there's people who are taking the de minimis rate. And so the de minimis rate is calculated based on modified total direct costs. So if you have a negotiated rate, you probably don't even necessarily concern yourself with modified total direct costs. But in any event, this is one of those threshold increases, right? So the prior threshold was you could take up to the first $25,000 of each subaward and take indirect. You can apply your 10% de minimis to that 25. Well, they've increased that 25 to 50,000, right? And so I actually have a pretty good slide that kind of depicts how this actually works. So actually, you know what, let's back up, because I actually want to make a point before I get into that. The de minimis rate, right, again, went from 10% to 15%. But did it? Okay, like a lot of people are just saying, great, like it's 15%. Well, when you read the language here, the 10% was definitive. You get 10%, right? The 15% is you may elect up to 15%, right? And so that leaves a wide range, right? Could be anywhere from 0 to 15%, right? And so this is one of those areas that I think there's going to be a lot of question on, because it's not definitive. And is it 8%? Is it 7%? Is it 15%? Well, how do we know, right? And so what we're anticipating is that the agencies are going to have to weigh in on this when you're going to make this election, right? There's going to be some sort of maybe evaluation process on behalf of the agency, the awarding agency, to, maybe question how you've derived that rate, right? And so this, this is one of those things that maybe could be in the bad news area. It is good news overall, because I think what they're trying to do is to obviously reduce that administrative burden. But again, I think my point is that I don't think this is automatic, right? And so just be careful with that. Don't just assume that you could take 15%. But what does that look like? If you go to the next slide, we put together like a little math exercise here to kind of show you, what is the change in modified direct costs and the de minimis rate. So if you look on the left-hand side, this is the current regulations prior to the October 1st implementation. So in this scenario, like you're allowed for the first $25,000. So you apply the 10% to that 25,000, you get 2,500. Well, under the new revised standards, assuming that this 15% is granted, right? You elect a 15, it's granted. Well, now you can apply that 15% to $50,000, right? So that gives you a $7,500 cost recovery, which is, it can be significant, I guess, to a smaller company, right? You get an additional $5,000 essentially to manage those sub awards. And I guess in my opinion, and doing sub recipient monitoring, and having been in that role where I've had to do site visits and do the monitoring and the risk assessment. And I mean, in fact, if you look at the regulations under sub recipient monitoring, there's a lot of stuff that you're required to do, right? And that costs money, right? And so I think, in my opinion, I think that this was an area that they maybe could have gone a little bit higher with, because, even, you have a $100,000 sub award, does 7,500, cover the amount for you to do all that? Maybe, but, usually these sub awards are a lot larger than that. And so, yeah, I don't know. Anything else to add there, guys?
No, I think to your point, it should be like 250,000, not 50,000.
Yeah.
Because sub awards
Yeah,
are incredibly burdensome to manage, and I don't think this gives any credence to the fact that these things are administratively burdensome to manage, and we're not allowed to really allocate a significant amount of cost to them.
Yeah, I think that's right. It's one thing on a sub award of 100,000 that you're getting 7,500, right, to manage it. But if it's $100 million sub award, you're still getting $7,500 to manage it, which seems a little out of touch. So that is definitely something that I've had clients struggle with the MTDC, because of large sub awards. They're just not given a lot to manage. So all good points. Okay, moving along. One of the other changes, I'm going to talk about two other changes here. The first was the fixed amount sub award. So some of you may recall when the uniform guidance was first implemented back in 2013, it created this new concept of a fixed award or a fixed amount sub award. And it set that at what was the simplified acquisition threshold, which is and has been 250,000 for many years now. But the benefit of those awards is that they are, at least in theory, supposed to be relatively audit proof. That as long as the amount is determined using kind of the principles from the uniform guidance, the cost principles and whatnot, to arrive at that amount up to 250,000, then you really weren't supposed to be looking behind it. I've seen a variety of approaches as it comes to these fixed amount sub awards over the years, but the bottom line is 250,000 is just too low. And so it is good that they've bumped that up now to $500,000. I've actually recently dealt with these sub awards and have had clients seek exceptions from the agency in well of excess of 250,000, but even in excess of 500,000, and been granted those exceptions. So there is a good use to these. Creates a lot of administrative ease and streamline. So it's good that they've kind of moved that number up a little bit. I don't think we have a backup slide yet to the next topic I'm going to talk. So let me flip back to the first, which is the prohibition on geographic references, the other change to Subpart D. So previously there was a prohibition that you couldn't factor in geography of contractors when selecting contractors. That has a number of pros and cons. I mean, pros, you didn't want certain states or local governments favoring, local business necessarily over national money, right? Federal money. It's national money. It's not developed from the tax base of any particular locale, but rather it's coming from, a national tax base. But there are sometimes some very good incentives for geographic preferences. When you think of disaster, right? Disaster recovery. One of the things you want to do is you want to put local people to business or to work, right? Get them back working. And also it's a lot more expensive potentially to bring in contractors from all over the country rather than using a local base. And so having geographic preferences also does have some incentive. So they've removed the general prohibition, but the rules still provide that, there are other kind of considerations outside of the uniform guidance that'll go into whether a geographic preference is acceptable or not. There's constitutional concerns, whether or not you're excluding, based on equal protection rules. So again, there's a lot of debate about diversity programs and whatnot within both the federal and state programs. But as long as those are deemed constitutional, then, those geographic preferences are now acceptable. Okay, let me flip it over to Dan, to you, I think. I'm going to talk about...
yeah, we can go through, just on this slide's fine, for the first one there. Yeah. So we're down to Subpart E. There was some prior approval requirements that they lifted as part of this revision. And the key thing to keep in mind here is that although these elements of cost, the entertainment, membership, subscriptions, professional activities costs, and participant support costs, so even though they've lifted the prior approval requirement, they have not removed the cost principle that is associated with these types of costs. And so there are still limitations to the allowability of these costs. You just now don't specifically have to seek prior approval before the incurrence of these costs, as long as they're, allowable, obviously. Right. So it's a nice step in the right direction and should eliminate some administrative burden. The next one, the subpart, also in Subpart E, for institutions of higher education that received greater than $50 million in awards previously, they had to complete a disclosure statement, a DS2 document, which is typically, prevalent in the CAS-covered contracts environment. And so whether or not they had a CAS-covered contract or not, if they hit that threshold, they're required to submit this DS2 and disclose in a very detailed manner what their cost accounting practices were for billing the federal government. And so now they've removed that requirement. What I will say is that if you're an institution of higher education, you have a CAS-covered contract, you're still going to be required to do a disclosure statement. It's just not going to be triggered by this arbitrary threshold. It'll be triggered by your CAS requirements via the contract that you receive. And then Subpart F, I think we had on that, but really the big takeaway there is that they increased the single audit threshold. So, for organizations that have tiptoed into federal grants, maybe this isn't a huge lion's share of your revenue right now, and you're hovering around that $750,000. It's a big step to go from not having to have a single audit to then having a single audit. I mean, it's a huge process. It's probably one of the most stringent kind of compliance evaluations a nonprofit would undergo in any circumstance. And so to not have to do one because you fall under the threshold would be fantastic. And I think that'll be the case for some organizations that were hovering around the $750 million threshold. And so right now it was $750,000. And then I just checked in the compliance supplement based on your question, Mark. And it does say specifically in there that this increase of the threshold from $751 million is for auditee fiscal years beginning on or after October 1st, 2024. So, basically you'd look for the year in which you'll be starting after these go into effect. So if you're finishing up a year, like in the remainder of this year, if you have like a calendar year, that year that is partially being covered by this will still be subject to 750, but then your new year will be measured at $1 million, and maybe you can fall out of the audit threshold there. But that's pretty much all there is on that.
Real quick before we go on to the next slide, I just wanted to let everybody know that the CLE code for today's webinar is OMB 2024. That's OMB 2024. Okay. So Dan, a couple other odds and ends that we were going to talk about.
Yeah, so these were not as impactful, and they weren't really advertised all that much, but I think they are positives, so it's worth mentioning. So what we're seeing right now with a lot of the Infrastructure and Jobs Act and IRA funding, there's a lot of commercial capital projects being undertaken that will generate either during the project or after the project program income. And so they actually had added an additional section to the program income section in Subpart D to basically say that there can be instances in which the agency allows for no further obligation after the period of performance for program income earned. So I think in many cases for these, organizations that are developing clean energy technologies or building energy producing solar arrays or whatever it may be, there is future income potential there, and this is good. It's an incentive because they won't have to, somehow credit or remit this income back to the federal government. It's very clear now that they won't be on the hook for that. At 203.18, this has to do with the procurement standards, and so as we know, competition is like paramount in the procurement standards. They want competition. Well, a lot of state and local governments, a lot of nonprofits, they typically like to leverage and get, be a party to a strategic sourcing or like shared services agreement with other organizations that are like-minded that buy the same things and everything else. And so if it's basically they provided a provision in here at 203.18 to say that in certain circumstances, these strategic sourcing and shared services agreements are going to be satisfying the competition requirements of the procurement standards. So you don't have to worry about, is this going to be acceptable? Like, we think it's strategically sourced and these are the best prices, but, is that going to satisfy competition? So if that's something you utilize, I definitely recommend looking at that update because there's some specifics in there that'll be important. At 204,
let me just jump in on that, Dan. I think this is a huge recognition on shared services, because often in the nonprofit space, there may be multiple affiliated entities, and they rely upon procurements and they rely upon the services of their affiliates. And in the past, it was kind of vague. Was that something we needed to compete? It's not really something we go to market. It's something that we get from our parent organization or something like that. So this recognition is a big boon, I think, for industry. Just wanted to jump in.
Yeah, definitely. The next one is administrative closeout costs. So if anybody's ever taken a grant through closeout, you've probably experienced this frustration. But what happens after the period of performance end date and the 120 days that you have to submit your final financial reports, right? Your staff are doing work to close out the grant. They're incurring cost. Well, previously, because it's outside the period of performance, you weren't allowed to charge that cost to the grant because it's outside the period. And so what they're basically saying now is that administrative cost that's incurred after the period of performance, but before the final financial report is due, which is 120 days for recipients and 90 days after the POP for subrecipients, you can incur those costs and you can charge them to the grant. So this is, I think, a good acknowledgement of that kind of gray no man's land period that existed there that didn't really make sense, and hopefully will help make organizations whole. And then under 204.14, this one was troublesome when they announced it back in November 2020, but they were going to publish everyone's negotiated indirect cost rates on usaspending.gov. quickly they determined, I think, that it was more difficult than they thought to collect all this information from the cognizant agencies. So they've tabled this for now. They've removed it from the uniform guidance. So at least in the short term, you don't have to worry about your indirect rate structure being made public and giving out all that competitive, pricing information to your competitors. So I think that's a good one to mention as well.
Okay, well, thanks, Dan and Marc, taking us through the good news. Unfortunately, I'm going to be taking us through most of the bad news as the lawyer, I guess. But so a number of different items that we've kind of put into the bad news bucket, and not surprising, a lot of these are legal in nature. The first one, the revisions to 200.113 is kind of near and dear to my heart. So previously on mandatory disclosures, the language says, or the current language says, that the entity must disclose all violations of federal criminal law. I actually read that to be extremely narrow, because first of all, it only applied to criminal law. And second of all, a violation is a definitive finding, and that can only be done for criminal law by a judge or a jury. And so that was, my reading was that's all that had to be disclosed. That, not surprisingly, has not been the interpretation by the federal agencies, and particularly the OIGs. In fact, many agencies, USAID being one, rewrote this portion in their own implementation of the uniform guidance or in their other, guidance documents, something that was much more akin to what we're seeing in the revised language, which is very close to what we see in the contracting world under the FAR, the Federal Acquisition Regulation, which is essentially a credible evidence standard that anytime there's what we call credible evidence of a violation of law or fraud, conflicts of interest, or things under 18 USC 1001, and the big one here is the N, the Civil False Claims Act, that needs to be disclosed. The FAR uses the term timely. Here they use promptly, so there is a slight increase in the timeline. But the credible evidence standard does imply that there is at least some time that an organization can collect whatever the allegations are that were mounted and look to see if that's credible. Is there credible information or evidence? The way to look at this, because a lot of the stuff here at the end of the provision is, talking about conflicts of interest and bribery and 18 USC, and then the Civil False Claims. The Civil False Claims Act is probably the broadest bucket here of things that need to be disclosed, because under Supreme Court case law, really what that means is the material noncompliance. And so if there's essentially the way that folks should interpret this is that if there's credible evidence of a material noncompliance, that needs to be promptly disclosed to the award agency. So that, again, we've been living with that since 2008 in the federal contracting side. And so many grant recipients kind of already are familiar with that kind of standard if they have contracts. But this is a significant deviation from the previous disclosure rules. So ones that folks should be well aware of. Okay, the next one deals with,
quick before we move on, I'd be interested to get your thoughts on it. Do you see this as basically OMB and the agencies voicing indirectly that they're not seeing right now the disclosures that they probably should be seeing, and so they're trying to strengthen their position?
Yeah, I think that's probably right, Dan. I mean, this kind of the difference between the FAR and the uniform guidance. When the uniform guidance first came out in 2013, was identified almost immediately, and OMB said they were going to update it and they were going to bring it into alignment, and it's 10 years later and they're finally doing that. So, I mean, I definitely think that is an issue, that they're not seeing the same degree of disclosures that they would expect to see, or they have been seeing on the contract side. And so, one of the things that will be interesting is, how much OIGs interpret this differently. I've seen the single award auditors interpret mandatory disclosure more broadly than what the language would say. I've seen OAG auditors and OIG investigators interpret it more broadly than what it currently says. So it'll be interesting to see if this is a real sea change or everybody's kind of already operated under this broader understanding. But yeah, I think they're definitely, at the end of the day, that it does remove, arguments that organizations did have that said, look, like, my reading the rules, I don't have to disclose this, right? And they had a credible position to take, and now they definitely don't have that. So important change. Okay, one other, several changes, but one other change in the 217 section is that they actually added an entire subsection. 217 is brand new and deals with whistleblower protection. So this is a new requirement that organizations, protect whistleblowers, have an anti-retaliation policy, and that they inform their workforce of these protections. The idea, and this kind of goes hand in hand, Dan, with what you were just saying, the idea being that they're also now telling folks, hey, report concerns, right? Report noncompliance internally, you will be protected. Again, this is something well established in the government contracting side, but not as well established or uniformly rooted in the grant side. Again, some agencies already have these types of protections, but now it's going to be, across the government, these new protections for whistleblowers. One more item I'll talk about, and then I'll turn it back over to my colleagues on the cost share, but in the internal controls section. So this is an area, in the last 5-10 years or so, we've seen significant growth and concern in cybersecurity, both in the commercial marketplace as well as in the government marketplace. And again, in the contracting side of the house, under the FAR, lots of established rules and requirements for contractors, particularly working with DoD, but even on the civilian side. Not as much in the grant world. What they've done here is they have mentioned that cybersecurity is a concern, and that your internal controls that you're mandated to have, you have to have all sorts of internal controls to be a grant recipient, timekeeping, things like that. But now the expectation is that you have reasonable cybersecurity controls. They don't mandate a specific standard like the NIST standard, but rather just say that reasonable cybersecurity controls are going to be necessary. There is some indication that they are thinking about beefing this up as time goes on. And so we'll see, Marc made a comment earlier about every 5 years them making updates, and now they're going to do those quote unquote periodically. So we'll see if they do a periodic update. This would be an area that I would fully expect them to update, which would be, mandating certain cybersecurity standards. Particularly, the big concern for the government is, they'll let nonprofits, your own networks and systems, that's your problem, that's your responsibility. But anytime you're interacting with a federal network or a federal system or federal data, right, they want to make sure that stuff is protected, right? So to the extent that you have certain sensitive federal data on your system or network, I think the expectation, at least that I would have, is that these cybersecurity standards will probably be imposed a bit more vigorously over time. But they're starting this by saying that we at least need to have these reasonable controls.
Yeah, on the cost share, moving on to the cost share provision at 203.06. So just to be quick on this one, as you may have noticed in some of the most recent FOAs and NOFOs, on the pre-award side, there's usually some incentive or some interest in voluntary cost share and how much an organization, whether it be a commercial business or nonprofit, is willing to commit to the project so that the government can multiply its impact on these programs, right? And so sometimes it's like, can kind of be looked at as like pay to play a little bit if they favor those above. And so basically now under the revised guidance, they're essentially discouraging that. NSF for a number of years has not allowed voluntary cost share because they didn't want that to kind of muddy the merit review process and like conflate who's going to get who's going to get their awards based on financial metrics, not the merits of their science. And so this is really kind of like bringing that into alignment. So it'll be interesting to see how this gets applied to some of these like public-private partnership and commercial projects we're seeing these days, because I think one of the biggest points there is, how much cost share can that entity bring to the table. So go ahead, Mark. I think the next one's yours, right? Under equipment.
Sorry, I was on mute.
Yeah.
Yeah, so equipment, I think we talked a little bit about the definitions here and how it changed from 5,000 to 10,000. This change here is regarding the requirements for what you have to do with your equipment, right? Meets that threshold of now $10,000. You still have to do the same thing that you were supposed to do when it was $5,000. Maintain property records, taking inventories, having serial numbers, safeguarding the assets. Well,
we have a slide on that too, Diz, if you want to advance. Sorry, Mark. Go ahead.
That's okay. Yeah, there you go. So we've highlighted the box on the right. The bottom portion says the recipient and subrecipient are responsible for maintaining and updating property records when there is a change in the status of the property. So what this means is they're looking for you to be maintaining an active, up-to-date, current inventory, and anytime that there's a change in the status of that equipment, you're supposed to be reflecting that in the records. I think in practice, what we see under the old regulations is that people just have this one static report and they look at it like every 2 years and they do an inventory and they update the records. But now what they're saying is that, no, that has to be current. As real time, things change. You need to maintain that those records. And so what we anticipate here is that the auditors are going to be looking at this, right? This is an easy thing for auditors to look at and have findings, right? So just be aware of that. Make sure you're updating your records. You want to move?
Okay. Yeah, real quick, there's one more before closeout, and that's the conflicts of interest. And so 318, this falls within the procurement standards of the uniform guidance, and they've always had language in there about conflicts of interest and ensuring that procurements are performed without conflicts of interest issues. However, there was probably an omission that was identified as it related to board members. So it talked about management and other personnel, making sure that there's no financial conflicts of interest. And most organizations have policies that do that. But now the uniform guidance includes board members as not having conflicts of interest, right? So if your nonprofit board is looking to contract with a third party and a board member has a financial interest, or a family member with a financial interest, that could be an issue, right? So those are things we just need to make sure that your procurement policy and the conflicts of interest of your organization account for a new party being potentially conflicted, or at least making sure that you're getting that information from board members so you can assess conflicts. But like I said, most nonprofits, they already anticipate board members as potential conflicted parties, and so most policies cover that. But it's an important change, nevertheless, for folks to be aware of. All right, Marc, I'll turn it over to you on the closeout, and that should close us out.
So, here, there's procedures you have to follow to close out your grant, 120 days after the period of performance, or 90 days if you're a subrecipient. This little thing that they've added here on the right side in bold, when the recipient does not have a final indirect cost rate. So these are people who are not using the de minimis, but in fact have a negotiated indirect cost rate or a provisional rate, right? So they still want you to file your final FFR, even though you haven't received a final indirect cost rate. However, what they're saying is that you then need to resubmit a revised final FFR once you do have that final indirect cost rate. Now, this is an area that we've seen, quite often where agencies are just closing out awards without final rates, right? And I think this is part of the regulations where they're trying to get agencies to do a better job. And so what they're doing is requiring you now to tell them what your final rate is. And the reason for that is to figure out, well, were you over or were you under on your rates, right? No one had ever really been checking that, right? And so this is sort of a way for them to be checking now, what did you apply as your rates, right? Were you just using a provisional rate all along and never truing up to your final rates? And so, yeah, so this is an area where, Dan and I spent a lot of time working in indirect cost rates, right? Creating them, figure out the best way of cost recovery and allocation. We advise companies to be calculating and monitoring rates on a monthly basis. And that's my point here, is that you can't just be blindly going into your award using your provisional rate and then not knowing where you are actually compared to that provisional rate. But even most importantly, now at the end of the grant, what's going to happen with that when you submit that final report? Let's say you're at a provisional rate of 30%, right? You had been billing and you closed out your award at 30%, but come to find out your final rate's at 20%, right? So what's going to happen? We don't know, right? But what I would suspect is that if you've kind of overbilled the government, they're probably going to want to credit back for that. So
they're going to want to check.
Yeah, they're going to want to check. Yeah.
And this is a way to police those checks now. I think in a lot of ways, right, the collection of amounts due has always been in uniform guidance. And if they overpaid you what your final obligation was, they owe a collection of those amounts due. Now they're basically saying, we want a certified financial report to solidify what you owe us or what we owe you, as if they would actually have any money left over to give you those additional funds. But some final rates could take years to be received from the cognizant agency after closeout. Mm-hmm. And so you're talking 2-3 years down the road, you may have to pay back money now based on, final rate determination. That's the way it should have always been. Yeah. But now I think with this language, you're going to see it get policed a lot more closely. And, just make sure if you're overbilled that you set aside that money and that's unearned revenue and you don't spend it on something else because you might have to pay it back.
This kind of goes back to while we're talking about this, I want to circle back to the whole de minimis thing, right? So what's happening in this scenario, if you're, again, using 30 as a provisional, but you're at 20, you've built in a fee, a profit, essentially, right? If you're recovering more than what your true indirect costs are, well, then you've earned a profit. That's how the government looks at it, right? And so my comment about the 15% may elect up to 15%, in being careful with that has to do with this concept of a fee, right? So yeah, you may elect up to 15, say the government is okay with that. You don't have to provide any other documentation, but I would still be concerned, or at least be monitoring what my actual indirect cost rate is, right? Just from a management perspective, right? Am I over, am I under? Is 15 the right number for me? Maybe it's not. Maybe I should be negotiating a rate because I have a 30% rate, right? And so what I mean about that 15 may not be guaranteed is if you're charging them 15 at the de minimis rate of 15, it's okay. You can do that. But what if you're at 6% or 7%? Are you overcharging the government? And is that really a fee? I don't necessarily know the answer to that, but I'm just saying it's something that you should be aware of and just be careful.
Marc and I are working on a thought, and I would that's titled "What is OMB up to?" with this "up to" language. And so one of the pieces in there that's really important is that it says they cannot force you to accept a rate lower than the de minimis rate unless there's a statutory limitation or there's an agency regulation that states otherwise. Well, the agency regulation that Marc's referring to is the prohibition on fee and profit in the cost principles in uniform guidance. And so that's what I'm worried about, and that's what I think we might see in practice. And so hopefully I have more information.
And I think the change in language supports that concern that you guys have, because the 10% was definitive. You get 10%. The up to language is far less definitive. So I think it's a great point and something that folks should be mindful of. So that gets us through our presentation today. I know we're a minute or two past an hour. So fortunately, I don't think we can answer any questions. Trying to be respectful of folks' time. But, you know, here's our contact information. Please feel free to reach out to any of us to ask any questions you have. Really appreciate Dan, Marc, your time joining us today. Thanks so much, everybody. George, I'll turn it to you, or Dan and Marc, if you have any closing thoughts.
Yeah, no, just very happy to be here today, Diz. Thanks so much. And good luck, everyone out there. If you have questions, like Diz says, feel free to reach out. We're happy to, you know, answer any questions you might have.
Thanks so much. Thanks, Marc. Thanks, Dan.
Thank you.
Take care, everybody.
See ya.